Hello everyone, this is Ryan with Numbers Up Finance, and today I just want to do a quick market wrap video for Friday, April 5th, 2019. I'll be very brief with it. I just want to go over the weekly charts for SPY and maybe a couple other things. Just discuss how the market performed this week. So obviously the talk of the subject is, how we're testing this 282 resistance level. We danced around it for about 5 weeks or so, and this week we finally got the push up that the bulls were looking for. If you were like me on the bearish side of the boat and you were looking for another leg down in a longer term correction, perhaps a recession, you wanted to see the opposite, which was a impulsive red candle in the opposite direction. But that didn't happen. The bulls got a gap plus a fairly impulsive candle on the weekly chart to put this 282 resistance level in clearly in the rearview mirror. So, we're just a couple percentage points off of the all-time highs at this point, and we are about $5 off of it. So there's a couple scenarios I could see happening. Now, I want to point out, too, I won't actually show it, but there are still divergences intact on the daily charts for SPY, on the momentum indicator and the RSI. So, keep an eye on those. Divergences, again, meaning higher highs in the price, lower highs in the momentum, or RSI. So keep an eye on those. I won't go over those for the minute. I just want to stay in the weekly charts real quick and highlight a scenario I think is very possible, should the longer-term bear market still be in play. So, again, these are the weekly charts of SPY, just a couple dollars off of the top. And, now that I think we got this impulsive move towards the bullish side, I think we're going to have another extended run-up, and here's why. Now that this was the toughest resistance level that this market had, and, seeing what we got about 8 weeks of impulsive moving up, finally testing this level, so overextended to one side, you would think, this is it. This has to be the correction. There's no way. I mean, this bearish engulfing candle, if this isn't the most bearish sign you can see after an overextension, period of one more time. Let's just go over this. A period of overextension, a bearish engulfing candle, and the strongest resistance level that you can find on pretty much only any chart, on almost any chart. And yet we didn't get that corrective move down. We still pushed up. You can't write this stuff. I mean, you still pushed up despite having all of those bearish sell signals. And now that we tested that level for 5 weeks, we finally pushed up and put in the rearview mirror. So here's what I think could happen. I think we will go to test those all-time highs. And I think from a bigger picture standpoint, we still have another level that we want to test before we see a stronger move down. So let's take a look at Fibonacci retracement levels for the SPY charts on a weekly time frame over about 20 years or so. So if we run a retracement from our 07 bull market highs to our 09 bull market lows, we can see various prices come up here. Again, our major targets are 38.2 levels, 50%, 61.8, 78.6, yada, 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 all that good stuff. And again, if you don't know how Fibonacci retracements or extensions work, I'd highly recommend you look them up, get an idea of how to do them. We should be putting a video out on them sooner or later, so they're a very valuable tool as a trader. Many traders use them. Some traders exclusively use Fibonacci levels. But, people will use them on the daily charts, the 4-hour charts, whatever. But if you do this over a longer time frame, the Fibonacci levels still are very precise. We can see many tags off of them in the longer term, and these aren't just small pullbacks. I mean, take this tag off of 123 back in 2010. This little correction that we got here was, that was a 16% move down. These are the weekly charts. These aren't just little rips and dips. These are, bigger moves in a weekly time sense. So in the bigger picture, we are still adhering to these Fibonacci levels. And the biggest one, of course, is this 161.8 level at 215. Look at how many long-term rejections we had off of it. We had a long rejection here where for about 10 weeks or so we were trading sideways. And then we corrected, we came up, tested again, failed, corrected, came up, tested again, failed for a little bit, consolidated, and then we finally pushed up and back tested it, and then we took off. So these mean something in a bigger sense. And the reason I bring these up is because our October high back in 2018 was at 293. Yet our next Fibonacci retracement level is at 306, 307, the 261.81, again, off of the 09 bull market lows. So, if this market is going to see another wave down, which I still believe it will, I think that we are just too overextended in the bigger picture. It's been a 10-year bull market. A lot of bigger economic signals indicate that we are going to have a weaker economic forecast in the future, whether you want to look at the 10-2 Treasury spread, look at unemployment levels. So many things you can look at. We won't get into that today. I think the market has one more thing it needs to take care of before it goes down, and that's to test this 261.8 Fibonacci retracement level. That to me is a reasonable explanation for the solid push-up that we've had. So, two levels you want to keep an eye out for moving forward now are, of course, you still want to keep an eye on this 282 level, because should we go back to back test it, it will be super hard to take it out now that we've taken it out with conviction. But keep an eye on the all-time highs at 293. I expect a heavy reaction there. And if we push if we push strongly past the 293 price point, 294 price point, then keep an eye out for that 306 all-time high, that 306 Fibonacci retracement level. Because again, if we melt right through that on the weekly charts, the all-time highs, this would be my next target to hit. And if we hit that target and then we get some consolidation, then we can start reopening the bear case. But in the meantime, we put this 282 resistance level in the rearview mirror. We did it with conviction. The bulls took a win this week, and we'll just keep seeing how the charts play out in the meantime. I also just want to go over the VIX futures real quick. Actually, we'll start real quick just looking at NQ. I just want to take a look at the character of the way this market's been developing. So, bulls have just been resilient. I mean, you've had so many signals, so many signs telling you, hey, this is the time this is selling off. It's just not happening. I mean, you've had this false bear flag pattern pay out. I even pointed out a bear flag pattern on the ticker symbol KRE a couple weeks ago. That was the regional banks, and that did not end up playing out, as many of you might have followed. I mean, even if you go on the hourly charts, you can see a bear flag pattern here, and then it was a false signal. So we tested this downward trend line. It looked like it was playing out pretty nicely, and we melted right through it. So now we've been hugging this uptrend line with a bigger picture uptrend line here as well. These are the NQ futures. So the character of this market has just been, in a bigger sense, fairly impulsive. It's been resilient nonetheless. And maybe on the daily charts, perhaps on NQ, you haven't gotten the type of impulsive moves up that you wanted to, but it's just been very steady nonetheless. And every time you think you have that, you have a sell signal developing, you have all the bear signals for one side of the boat, and it looks very good, it looks too good to be true, it just doesn't play out. The bulls are taking it, the bulls have won with conviction, and I would expect more weeks of strong buying to come. That being said, don't ignore the divergences on the daily chart. They're still very small. They're very smallly intact for the futures and for NQ and ES and all that, but keep an eye on them. They mean something. We're still very overbought, and we could see a little pullback, but I wouldn't expect a longer term move down until perhaps testing those retracement levels on SPY. So again, we'll just end it with the VIX future, and here's just another bullish sign all the way. This channel for VIX has been so defined over the last couple months, and you've been able to trade it so cleanly. And for anyone that has been trading it, we've had 2 times lately where you can get back in on it. So you set a purchase right here at the stop below this line, and it failed. So we gapped above, and we entered this trading range again, and it looked pretty promising. So we came back down, we tested it, and here was our false buy signal for the green candle right here. It looked like we were going to play out, because obviously when the VIX moves up, the market moves down. Here, we thought the market was overextended. We thought it was time, for a pullback, and it was a false signal. Now, VIX is it's kind of in free-falling territory again, because, again, this channel's been very, very predictable over the last couple months. It didn't play out. So, that being said, I'm kind of putting my bearish case on pause for a little bit. That doesn't, the only thing keeping them alive for me are the potential divergences on the daily chart. And should those start to play out, I will rehash my position. But in the meantime, I want to go see SPY, go test the all-time highs, and then I would really like to see it test that 306 level, that upper echelon Fibonacci retracement from the 2007 or 2009 bull market lows. So, but yeah, other than that, stick with it, get your numbers up. This has been Ryan with Numbers Up Finance, and thank you for listening.